Welcome to the i3 webinar on risk-managed thematic investing, co-hosted with Allspring Global Investments. I'm Teck Tan with the Investment Innovation Institute, or i3, and I'm pleased to have Wai Lee, co-head of systematic research at Allspring Global Investments, join us today. Wai joined Allspring from its predecessor firm, Wells Fargo Asset Management, and prior to that, he was with Neuberger Berman, where he was head of quantitative investments and a senior portfolio manager. Before joining the industry, he was a postdoctoral research fellow at the Harvard Graduate School of Business. He's also the author of the book Theory and Methodology of Tactical Asset Allocation. Wai currently serves as the advisory board of the Journal of Portfolio Management and the editorial board of the Journal of Systematic Investing. Now, thematic investing opportunities today are often positioned as active investment decisions in an attempt to add active returns. Now, themes are perceived trends that are expected to materially change the economies in revising existing and or driving new business models. In fact, themes that materialize ultimately become structural. However, even transitory themes that fade away over time can determine some characteristics of the investment opportunity set, and therefore important considerations for strategic and tactical allocations. So how do we define themes? And having done that, how do you apply? As we'll learn a bit more shortly, Wai defines themes as missing factors. Now, over the next 40 minutes, as I mentioned, we'll first and foremost define or at least put a framework around what is thematic investing, and more importantly, discuss as investors how we can apply and express them in our portfolios. Now, I encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. Wai, welcome to the webinar.
Thank you, Teck, and thanks for everyone who dialed in. My great pleasure to be back to i3 and sharing our thoughts on some exciting topics such as thematic investing. So thank you.
Thank you, Wai. Now, Wai, I know you've done a lot of work on factor investing in the past, and I understand. So factors explain and identify the behavior of assets, whether it's their potential return profiles, volatilities, and the correlation with other assets. And as I understand, for factors to be recognized as such, they need to be proven to be persistent and they work across multiple markets or regions. Now, you've described themes as missing factors. Can you elaborate?
Yeah, so first of all, I want to repeat what you said in the disclosure already. This is an educational session for my education as well. We often found the best research topics are those topics that are relevant and commissioned by the investors, by our client. This is thematic investing is absolutely one of the few lately. And then we have known each other for a number of years now, and then you might have noticed that I have a personal preference, which is I like to go back to the drawing board and think about if there are anything we have learned from school, maybe in pricing theory, maybe a model, maybe a factor lens, maybe some concepts that can help me frame what we practice in the markets day in and day out better. So to that end, I think when we think about thematic investing, so I frame it using the factor lens. And on one hand, this is truly how we think about it. On the others, it's like thematic investing might be the last 5 or 10 years, getting more and more popular. But it's not really something entirely new in our opinion. So let me try to take us back to, if you don't mind, half century ago, to the 60s, more than half century ago, when we first had the capital asset pricing model. And that was what I would consider a normative model describing what should be, right? And the model told us if these assumptions are satisfied, then there's only one factor you need to care about is the market factor. Now, the subsequent 20, 30 years, and I think it was because of several things happened. It was the more data collected, a CRISP database, CompuStat database, advance in computing power, and we have witnessed a number of empirical studies which would lead to what I would consider as, I call it a big bang of empirical asset pricing. And we found these factors documented by the data such as the low beta premium, actually, it was first discovered in the 70s, and PE ratios, size factors in early 80s until like early 90s, Farmer French institutionalized them and switched to book to price for it value. A size factor small minus big, then you have momentum, quality, accruals, profitability. To these few years, non-linearity, machine learning, and the like, right? So when I think about all these factors documented, they all share some similarities. Is, as you said in the beginning, Dick, they are established because, or else the researchers would not have found them in the data, right? They must have been established, have been there for years. They are structural, meaning that even though they might not be as volatile or important at times, but they don't go away. They come back, right? They are structural. And they are normally universal, means they are pervasive enough to, in technical speaking, they mean variance span the whole universe of investable assets. So they are established, structural, and universal. And when you think about themes, as you described, they are perceived trends. And almost by definition, themes are early, themes are emerging. And there's no guarantee that all these themes of interest to the investors now can become structural in the future. Some of them may drop out, some of them may become truly structural and the like. And there's no guarantee they are universal. They may be just relevant for a subset of investable assets. So when you add up all these considerations, almost by definition, themes fail the definition of factors for now. But again, some of them will become structural factors. And at that point, the risk model vendors that many of us subscribe to, when they have enough data to be convincing that, oh, actually there were some new themes becoming factors, they might incorporate them to their risk models, and boom, then you got more factors, right? So I think just to sum up in the beginning, that's why we think all investors, whether you are fundamental, systematic, or mixed, all of us should consider these themes because they are in your reports card every day when you are in the market. And one last point to share is more than 10 years ago, there has been some research documented. If you have missing factors in your risk models when you optimize, actually the optimizer would have overloaded on those perceived to be idiosyncratic, the missing factors, because it was incorrectly considered as diversifying. And you may be overloading on some of them without knowing it. So in summary, I think we should all consider like how do you visualize themes better so that we can be more like comprehensive in the way that we invest.
So I guess as I understand now, look, we agree, and obviously not trying to get into debate. Factors are persistent, and we're familiar with the usual factors, there's Farmer French and the like. Themes are somewhat emerging, whether they're defined as factors or otherwise. What I'm hearing is that there's still a need for investors to figure out how do you incorporate them. Obviously, at that stage where they're kind of emerging, are they transitory? Are they more structural? It's hard to. So, just on that point, so how do you define themes, especially when there are those emerging, they're not sufficiently reflected, as you mentioned, by various data providers, the market data? How do you capture them in the models and sort of on a look forward basis?
Yeah, that's really the challenge. And I think these years, when we talk about thematic investing, we tend to think about the ETFs, right? Because there are actually about 100 of them around, and they tend to be on a single theme, tend to be pretty concentrated, some of them as well, holding like just like maybe 2 dozen, 3 dozens of names. But in any event, is all of us are playing in the same sandbox. As if we agree themes are emerging, that means no one has the market data that reflects enough that you can do some statistical estimations and the like, unlike the other factors, right? So I think to that end, we may want to bring in a branch of economics. I think some economists call it narrative. Narrative economics is to analyze how some popular narratives can drive economic behavior. There are actually some books published entitled with Narrative Economics, if you are curious about it. And I think this is where some of the recent advances in NLP, for example, natural language processing, can be helpful because it can help us to analyze text, such as if you don't have the market data, right, you can look at patents filed or patents granted to get a peek of what the insiders the executives of some of these companies are having more higher conviction on the new advances. You can look at job postings, earnings calls, and the like.
Right.
But just as to begin, right, when we try to visualize more and more themes, we may as well just start with news. And it's very simple. The idea is very simple. Just look at the news intensity. We can look at the news, like in the next slide, I actually have a couple examples to show, because when we tested some of these approaches that we are developing, we found some themes that are actually relatively new. And a couple of them are, as shown in this slide, biodiversity. And why do we call this relatively new is because we can't even find too many companies to be associated with news around the keywords like biodiversity. And the second keyword that we tried is deforestation. So these two charts, actually, what you are seeing at is we try to group them by countries. Because if I group by companies, sometimes there are maybe a dozen of them related to biodiversity. And you can see on these charts, right, it's the x-axis may be a little bit small to see, but if you look at the top chart like biodiversity, and you see a starting to spike up in the news intensity around 2020. And there are two very clear spike up. One of it was in December 2022, and we believe it corresponds to the meeting COP15 in Canada. And actually, the first color that I labeled is the Canada, the news intensity about biodiversity in Canada suddenly spiked up, and the top one is in the US. And the more recent one you will see spike up is May 2023. And when we do a word cloud of that month, and this is a little chart that you see the picture to the right of this of the chart, you can see the visualization of what words are most often mentioned in that month. What news is the biodiversity index. Quantico actually launched the biodiversity index in Europe, and maybe that's why Germany had a sudden spike up in the news intensity as well. So to your question, when we deal with these emerging themes, we think maybe starting with the news intensity, which I can define briefly in the next couple of minutes, is that may be a right starting point because it reflects the attention we are paying to these topics.
Well, just on that point, I'm picking up 2 points. One is news intensity, which I'll come to it, and the other thing, a comment you made about being country specific as well. So on the point of news intensity, is this using whatever AI or natural language processing to collate the number of mentions or the intensity of mentions and the like? I guess my question comes up to how confident are you in that kind of source of information in backing up your thesis that this is an emerging theme?
Yeah. So the confidence is really the big question. Sometimes, like,
Yeah.
sometimes we may observe. In fact, there are some papers already that documented as everyone has access to the NLP technology now. I mean, you can debate about the sophistication, complexity, but there are evidence that some management already changed the way they talk because they know someone is listening using a machine. Right? So you become more aware of what you are supposed to say, what not, etc. But regardless, when we look at, we actually test drove some of the themes that we believe to be more tangible. And we found that our approach actually overlapped quite well with those topics such as robotics, such as artificial intelligence. Now, arguably, some other themes can be more like vaguely defined. What is deglobalization, for example, right? So I think it varies. And at this stage, we think maybe a systematic approach can be complementary to the fundamental approach. But we would like to have something more tangible. And I can go through some examples, like even the themes that such as robotics, for example. Well, robotics, I think we understand is not like a transformer robot is standing in front of you, but it's how robotics in general can enhance your productivity and profitability and the like. Even some more tangible concepts, when we look at the agreements across different investors, it can be surprisingly low. And again, we can cover some of those in
Yeah, I'd
subsequent
like to get to the
discussion.
application in a moment. I thought we'll finish up the definition bit. So my follow-up question is around country. So are you
Mhm.
saying that certain themes are restricted or constrained to particular countries only? Is that what that means?
Yeah, so in some of the cases that we analyzed, because we found insufficient number of stocks or companies associated with certain themes yet, we try to switch gear to look at what if we group them by countries, and that may give us a different perspective. Now, I think arguably, if you really want to put it into practice, you may work with index, but I think the conviction level from our side is
Sure.
we would rather look at some themes that, well, yeah, by definition, they are emerging, but at least it gives us enough breadth to pick on the stocks, the investable universe, so that we can build a more diversified exposures to some of these selected
Okay.
themes. So back to your question again, take like country is a workable concept, but it's not the best vehicle
Okay.
in our opinion.
Okay.
It would be
Yeah.
better on the individual stocks.
And maybe final question on the definition bit before we get to application, which I think is more interesting. My colleague had interviewed you for an editorial article a while back, and I picked up on one of the comments where you mentioned that you built a factor or theme, again depending on how you define, called the stay-at-home factor, which obviously relates to COVID. Now, we obviously know Farmer French and the other factors, but I've never heard of this stay-at-home factor being used in models. Are you serious?
Okay, absolutely. We actually did not have the luxury of not being serious about it. I think for those of us who were in the market, like you, me, and many of our clients, right, you actually experience it every day in the market. And we don't have to look far, right? Just if you have the leisure to go back in time, look into the day, November 9th, 2020. And those investors in the market should have experienced a very sharp rotation of relative performance among some stocks. And I'm quite confident to say no risk models we subscribe to would have been able to explain that sudden rotation of performance. What happened on that day is when Pfizer and BioNTech announced the vaccine, and investors actually use their money to vote what stocks they believe to be beneficiaries of if we return to office, and vice versa, to stay at home, right? So there's a
Mm,
sharp rotation. You experience it in your report card, your P&L from the market every day. But again, your risk model missed it. So we quickly took advantage of that snapshot of the market, of the stock performance that day, and did some analysis backward as well, and created this factor we call stay at home. And it's really for the purpose of augmenting the risk model we might have subscribed to, some like industry standards of risk model vendors, because our clients actually experience this in their portfolios. Now, to fast forward to some time later, we actually challenge ourselves is, well, we waited for the market to show us that rotation, right? To clearly define what is the stay at home supplementary of analysis. How could we become faster next time when we were dealing with some missing factors that now we consider them to be themes,
mm,
without waiting for the market to reflect them, right? So that's where we use the NLP and look at news intensity. And maybe
mm,
at this point, I quickly define how do we do it. It's very simple. We look at two dimensions. One is a time series domain. Is we look at each company, how many news related to this company is associated with a theme, a keyword, a phrase, and the like, relative to its own history. So that's a time series domain. The second axis is cross-sectional. You look at all the news in a snapshot to
mm,
all companies. Uh, how often is the company associated with a theme relative to the companies? And most of the time, we found actually these two domains quite look alike. So you cannot go too wrong with either one, or you combine them. And
mm,
what we call a theme is very simple, just like you rank by book to price, right? The standard like high minus low factor value. You rank them by we rank them by the news intensity, and go long those companies with higher news intensity, and go short the companies with lower news intensity. Now, at this moment, I want to just state it clearly. we are not claiming that this is the definition of themes, but it will be a pretty robust starting point, because for some
Sure.
companies that have never been associated with any news about our themes, unless you have really confidence to say that you're ahead of everybody, right? Otherwise, it will be quite difficult to defend. How come you think this company, never associated with the news, is relevant to a theme? So
Got
that's
it.
how
Yep.
we just, in
Good.
a brief way to describe it, how do we create a thematic factor?
Thanks for that. No, I'm going to park the definition one side. I think you've come up with a definition. I'll welcome comments or even critique from our audience, whether you agree or disagree. But I'd like to move on to the next part, which I think is about the application. Now, in your earlier comments, you talk about ETFs. Now, we know, obviously, we often associate thematic investing with ETFs, and there's no shortage of them. They're simple, they're straightforward, they're direct, they address particular themes. Is it effective? What are your thoughts?
That's a question. Like, is it effective? Like, how do you measure effectiveness when themes are relatively new and emerging, right? So let me give you some statistics. And for interest of time, I could have posted these questions, but just for interest of time, think about robotics, the robotics ETF, and you can actually find quite a few of them that are pretty sizable. And if you just look across, let's take a snapshot of their portfolio holdings. Uh, Only 30% of their holdings on the average are overlap between any two randomly selected robotics ETF. Only 30%. So the question pops up is, how do you measure the effectiveness when 70% of their holdings are different? So who is right? Who is wrong? Maybe the question is not about right or wrong, right? It's about like, is it the right time for us to explore somewhat like a standard? A standard doesn't mean everyone has to follow, but it may serve as a reasonable starting point. And that's where we try to come in with some sort of a systematic approach. Now, on this effectiveness, we do think of them as it's very difficult to scale, because you are talking about deep dive analysis of hundreds, if not 1,000 companies, to what extent they are related to a themes. That's number one, right? And number two is, I think we are seeing more complexity and increasing number of themes that can span across different markets, industry, or even time horizons, time domain. So how do we work with a fundamental team that have to switch? And when a theme comes and goes, it doesn't mean that you can forget about it. You may still need to pay attention to it and the like. So scalability is one challenge. And the second challenge we observe is, when you open the hood and pass through their holdings to our now augmented factor lens with the standard factors as well as the newer themes. As an example, on this slide, we actually passed a robotic ETF through our now augmented factor lens. And it may be difficult for the audience to see how we group them. To the left, there are 6 selected themes that we just selected them because they are more tangible, like robotics, cybersecurity, blockchain, biotech, AI, and the like. There's a little orange bar in there. And that is what we found to be the risk contribution of this robotic ETF in relation to robotics. It's tiny, but most of the risks, actually each of the bar to the right, are coming from the standard factors like leverage betas, like profitability, size, and the like. So I think this is the second challenge, is when you look through the factor lens, you may be surprised. Actually, most of the risks of an ETF, a thematic ETF, can be unrelated to the themes. And again, that subjects to, my statement subjects to if you agree with our definition of themes or not. And
Yeah,
finally,
yeah.
the point is the unintended risk that as we explained in this slide.
I think why, again, for the benefit of audience, I'm just looking at the slides, and these slides will obviously be available to the audience. You have under risk concentration 0.2% robotics, but a whopping 4.2% on market data.
Yeah.
That's such a big difference. And then you've got market size, which is 2.7, and the rest, which are a lot, your what you call your usual standard factors that we're familiar,
Mhm.
outweighs totally the robotics. I guess that comes down to the definitional challenges as well as the difficulties there.
Yeah, I think that reflects, in our opinion, is a lack of augmented factor lens to look through the holding in order to understand what risks are underneath.
So if that's an issue, a so-called traditional, thematic approaches, what do you mean by a systematic approach? I mean, is there a differentiating approach to be a bit more comprehensive in looking at these emerging themes?
Yeah, I think the next slide that I prepare an example. Now I switch to cybersecurity and
Mm-hmm.
maybe start with something that are all familiar with, right? And I was mentioning about the farmer French book to price ratios, the high minus low factor. So it's very simple. You order the book to price ratios of the stocks in descending order. You go long the top, short the bottom, as simple as that. So in the case of cybersecurity to the left, the chart to the left, you do the same thing. You rank the news intensity of the companies from highest to lowest, and you can winterize some, you can do some transformation to make the distribution looks a bit better to you. That's subjective, right? That's a bit like choice of different investors. And what we have tried in this case is after we rank the stocks news intensity of cybersecurity, we found the cybersecurity ETF, look at their holdings and populate them on the same chart. And those are the orange circle you see on the left chart. And indeed, we found that most of the holdings of the cybersecurity are on the top half of the news intensity. But interestingly, there are actually a few of them below average, as well as some holdings have never been found to be associated with news about cybersecurity. That is not a statement to say, well, you are doing something awkward, but maybe they are just ahead of everybody, right? So at this stage, we think a systematic approach can serve an interesting starting point. Much like, again, right, when you invest in the value portfolio, not everyone agrees with book to price as the only metric. You can supplement with some others earnings growth. You can look at other index providers, but at least with these index, so-called value index, or now in the case of cybersecurity, we we have a more a shared dialect that we can talk to each other. It may serve as a purpose of a core, a starting point, and then each one of us can debate about it. You can deviate from it, but at least we are trying to create a common dialect across many investors. And there will be some type 1 error, some false positives. We will acknowledge
Mm-hmm.
that. And there may be some type 2 error, false negative as well. But regardless, again, the whole point is let's start with something repeatable and transparent.
So you have as you mentioned, a kind of a common language with systematic definition and so on. How about fundamental? I mean, things can be subjective. Does this blend with a fundamental approach? How do you bring it all together?
Absolutely. I think the two can be very complementary, not only on thematic, on many other investment topics as well. And again, I repeated what I just said before. We think it might be helpful to use a systematic approach as a starting point. And
Right.
then the next step can become optional, right? We can pass the systematic screening through a fundamental team for doing some deep dive analysis. They can help us to screen out the type 1 error just because some companies hire some marketing efforts, right? Just to talk
Mm-hmm.
about the keywords and the like and appear to be very relevant. A deep dive analysis by our analysts can be helpful. And if we become like more like the conviction is higher that certain stocks are really relevant, then you can amplify the positions in your thematic tails when you are ready to build the portfolios. As a matter of fact, we have already started some collaboration with some of our colleagues, like look at artificial intelligence and even like some other
Mm.
topics like water, right? So I think the flexibility is really there. But again, systematic serves a more transparent starting point, and what you do next is really optional and beneficiary potentially.
Right. Right. If it gets stuck in the deep end, I mean, give us an example. I mean, you've defined it, you've have a systematic approach, you complement with fundamental. How do you bring it together, like in a portfolio? Do you have an example for that?
Yeah, yeah, I think I can give you two examples. Maybe start with a more a simpler one, and we can look at the AI, for example, artificial
Mhm.
intelligence. And now in here, what we are showing is look at a systematic approach to construct a single theme AI portfolio with some reasonable parameters that I'm going to skip the details in here, but just single focus AI. And then we compare and contrast to a listed ETF, which is one of the largest. The name is listed in there in the table. But at this point, I don't think the performance are as important for us because this has some hindsight bias in there. We picked AI because we knew it was meaningful and successful in the last few years. But where I find it interesting is when we pass through the portfolio holdings of a systematic approach and the existing ETF through our augmented factor lens, we got very different pictures on the risk underlying them. So let me start with the lower left chart, which you see a tall bar about 10.1%. That is based on a snapshot taken about half year ago of the ETF. And we analyzed the risk decomposition, the tracking error. And it's a bit unfair because we just benchmark it against the most difficult index, the S&P 500, right? Maybe that's not the right index, right benchmark for them. But regardless, let's have this hypothetical analysis. What we found interesting is of the 10% tracking error behind this ETF, about 4% of it is actually coming from leveraged market beta. That's the top light green color. And about 1.5 or maybe 1% is coming from what the others like style factors like size, momentum, and the like. And then there's a bit of idiosyncratic risk, the specific variance, which no one can avoid it. And down below, the somewhat like light purple color is from industry. Now, very bottom, the tiny little thin bar, I don't know how, maybe 50 basis point of it is coming from what we define as AI. And which at this point, I would like to clarify it. When we try to define the theme, we also find it helpful to purify it because we acknowledge that some of these themes like AI can overlap with some from existing factors like industry, like a growth factor and the like. So we purified it, and I'm going to skip the technical details in here. We actually published the details a few years ago in some journal articles. So this is what you got from the ETF, okay? Tiny little bit from the AI purified theme. Now, if you look at the bar to the left, which is the 4.7% number, that is based on the last snapshot of a systematic AI portfolio we constructed hypothetically. And what's interesting is you see very different color distribution. There's a tiny bit of the green in there, like the market beta, bit of like style factor. There is idiosyncratic risk, and there is a bit of industry, maybe 1 to 1.5%. But the AI themes is about 1%. Now, then you question, how come you guys try to purify it, right? But you're still only 1% or 1.5% out of the 4.7% risk is coming from AI. This is one of the places that we found interesting is that may reflect the fact that the current state of the market might not have fully reflected the potential of AI. So when we are trying to take a risk as high as 4.7%, we don't have a choice but to package the risk from some other existing factors such as industry together with a purified AI theme. So if you ask me, right, this is a bit premature, but just for full disclosure, I feel like the risk that we can touch the glass ceiling of the purified AI is about 1%. It's only about 1%.
Why, as you say that, I can't help reflecting, and I might be agitating people the wrong way. We know about greenwashing in ESG. I just wonder if there's this thing called AI washing, where effectively the risk composition, as you mentioned, whether it's the ETF, there's a lot of it is really about market data or leveraged market data, and according to your definition, much as you try, you can only get 1% at most, or at this point in time, true exposure.
Yeah, I think up to this moment, I would say yes, that's what we found. But again, right, that is not to say AI is not AI is absolutely meaningful. But again, as we discussed, like themes tend to be emerging and relatively new. Give it more time. Who knows if some years later there may be a new factor in the standard industry risk models that many of us subscribe to. You will see an AI column in there. Biotech was an example. 25 years ago, right? Biotech became more and more important, and then now you can find the biotech industry in there.
Sure, sure. Yeah, I guess that's the view about emerging, and it hasn't been truly reflected.
Yeah.
The other thought that came across my mind, and it was a discussion in a different forum around how do long-term investors approach technological disruption, AI and the like. And one of the options, again, as you talk about that, I was just reflecting, do we want to be so specific to target these themes, or do we just, as long-term investors, do nothing? Because at some point, these themes will be reflected in the market beta. So why bother? Now, again, hopefully I'm not being too controversial here, but I'm flipping it the other way around. I know we're talking thematic investing, but it's worth thinking about the other side.
Yeah, I hear you. So like we used to call this a zero-sum game, right? There's a buyer, there's a seller, like growth versus value. For every value investor, someone has to sell you the value stocks, right? For different purposes, different objective functions. So I hear you. It's almost like getting to the debate of active versus passive. And the topic is themes, but I may as well throw out some of the reasons papers I study, and some of the audience might have seen the same about. It's not really concentration, but it's about where did you get the equity market risk premium from? And one study that I found was on the last century of the US equity premium. In fact, you know what? You only need to identify the top 4% best performing stocks in the US ever listed. 4% of the best performing stocks actually accounted for the entire equity market risk premium. The 96% of them kept weighted actually matched the cash returns. So that's a different forms of concentration, right?
Yeah.
And in the
Yes.
non-US, they have less data. They have 3 decades of data. Another study.
Yeah.
The number is actually even more alarming. Less than 3% of the best performing non-US stocks actually account for the non-US equity risk premium. So what are we talking about in here? Why don't you just hold the index? Well, I think that one of the reasons behind these alarming numbers is because of the nature of equity investing is limited liability, right? You can lose at most 100%, but there's an unlimited potential for gains. So if you miss out a few of the stocks that eventually became so dominating, and a week ago we would have called out Max 7, right?
Sure.
And the like. If you miss the big winners, there may be a chance that you underperform the index. Now, if you
Sure.
port this wisdom on individual stocks to themes, I think at this moment, if you ask me, is I would like to be ride with the crowd. That is not to say to become passive, but I would rather identify a set of diversified themes and tilt towards them. I don't know which 3 or which 5 of them will become structural and potentially become like the alpha
Right.
generators. I don't have
Yep.
a crystal ball to call for them yet,
Sure.
but I don't want to be left behind. So
So
rather
how do you
than
bring it
concentrating on
all
a theme or
together?
two, yeah.
Like
So that's
you
where
bring it together in the market.
yeah, maybe I will quickly show you the last example that we did in the last slide is, and again, this is a bit of hindsight advantage is I combine 6 themes together, and without our systematic technology, the easiest way is why don't you just buy 6 ETFs, right? That's the last column, what we labeled as the multi-ETF combo. Just equal weight them for now. I mean, forget about how much risk they are taking. As simple as equal weight them. And they did give you a pretty high tracking error. And again, the performance is not as important for this session. They have hindsight bias. Versus you may buy just one ETF and allow me to use the ARC, which is labeled as a more like a multi-themes looking at emerging stocks, etc. And it has super high tracking error, almost like 30%. Or you can combine them in a systematic way and assign reasonable risk allocation to 6 themes together. That's labeled as a systematic multi-theme portfolio. So down below the charts at the bottom left is where we show the sharp contrast. It's the systematic approach, and again, you can calibrate it at different risk level. And for this one, it happens to be the tracking error realized is a little bit under 4%. and versus the arc, which is to the right, and it's like 27% tracking error. And you can see the green color, how dominating actually the market betas and style factors behind the ARC portfolio. And you can hardly find the dark blue color, which are the purified multi-theme. So the one last interesting observation we make in the systematic approach in here is when you look at the bar charts to the left, you don't see the green color anymore. They are tiny, tiny little bit. And I think that's the power of multi-theme diversification. If you recall the last example, single theme on AI, you did find some green color in there because I said, well, I almost had no choice but to package some other risks. But when you let me do multi-themes, because each theme has different exposures, purification to the existing factors, when you combine multi-themes together, they produce a diversification benefit. And we no longer see much green color anymore. So this multi-theme systematic portfolio is essentially about half is related to the multi-themes, half of the risk is idiosyncratic. So I think that presents a pretty interesting alternative, again, to work with a fundamental approach. And again, the last is this is very transparent and repeatable, subject to the agreement or disagreement, if you will, on whether news intensity is a good proxy for relevance.
Sure. A couple of questions, I know we're wrapping this up. I guess you're proposing a new way of thinking through. It means for most models, is there a need to redesign, it's a question in the audience, or redevelop the in-house risk decomposition model to consider both these factors?
I think that's really the key. That's really the key. And take your earlier question on stay at home was such a powerful example. Every investor experienced it, but it was not in your risk model. What would you do? Right? So now going forward, if we have this methodology around us, and I can give you some examples, like the biodiversity example, it was not in our study before, but because I read that this is one of the top interest in some Australian superannuation funds, it took us less than an hour to click some buttons and run some Python code to track the news intensity, as well as estimating the biodiversity thematic payoff and decompose the risk and look into like how much of it is due to idiosyncratic, country related, and the like. It took us about less than an hour. Okay? So I think going forward, as we more develop this approach more, it can become a more like adaptive and flexible approach. And then subsequent, you can complement with more deep dive analysis. So it's about augmenting your risk model to make it more comprehensive.
Yeah. And look, there's a final question which you don't have time, but it relates to factor timing. But I think you've sort of answered it through the course. It's really a longer term horizon. It's not about timing and dynamic, but it's a longer term a journey as you observe how these teams develop over time. Wai, thank you very much. That's all the time have for this webinar. It's been really meaningful and interesting. As you mentioned, this is one way of thinking. Hopefully, this will agitate the investors to think about different models, incorporating upcoming emerging teams and the like. Thank you very much to Wai Lee and the team at Allspring. And for our audience, I hope this has been meaningful. Thank you, and we hope to see you another time. Thank you very much.
Thank you.